do you have to have mortgage insurance in order to qualify for your mortgage?
So there's two different types of mortgage insurance, depending on what you're talking about, but I think it's mortgage life insurance is what we're talking about specifically.
Yes.
So no. And again, the impression that is often left with a lot of clients is that I need this, otherwise I can't get my mortgage. And that's often how it's being framed. And somebody, when I first bought my very first place, I remember the conversation that the bank had with me, and I really felt this pressure of needing to get this. But again, luckily I had a great team with me at the time that said, no, Ryan, you don't need this, but there's other options that you can look at to help protect your family.
Wake up, it's time to rise. Talking money, my sharp insight. Jim and Ryan here to guide. Mastering the money ride. Saving stacks and planning dreams. Living large by honest means. Tune in now for the schemes. Breaking down financial themes. Money mindset every day. Mastering.
Welcome, everybody, to the Money Mindset Mastery Podcast. I'm your host, Jim, and a lot of people ask me, who's that handsome guy that joins you on your podcast? Well, that's my co-host, Ryan Janot. Ryan, how are you today?
Well, thank you very much, George Clooney lookalike. I'm doing well, and I'm very...
You need new prescription glasses.
Very happy to know that I've been outside staring at the sun because the sun isn't out there. That's probably what's blinding me a little bit. But
right.
Thank you.
So all good today. Well, we're going to talk about something really fascinating, and I'm sure a lot of people are not going to think it's fascinating. However, it's very important to know and understand is the difference between mortgage life insurance and your own individual insurance plan. One of the reasons why we're bringing this up today right now is as we're heading into the spring market, people are going to be looking at homes, possibly even renewing their mortgages. And I will guarantee you that if you're dealing with a bank, they will offer you a mortgage life insurance policy option. Or if you're dealing with a mortgage agent or broker like John at TVH Mortgages, he will also offer you a similar product because he has to. And we just wanted to highlight really the major differences and why you might want to consider one or the other. Ryan, what's been your experience with mortgage insurance?
Not good at all. And as you said, often people come to us asking this question about what is mortgage insurance and understanding. And as we will go through more details, but the most important information I think a lot of people need to know is the post underwriting process that comes with it and how that affects them when it comes to the payout. Because when people think about any type of insurance, they think upon my passing, the money will go within days to my family. And that's not the case when it comes to this particular type of product put out by banks, known as mortgage insurance. And as we will go dig deeper into what that is and the importance of understanding how it's structured, what is the payout rate of those, and where does the money go upon the passing of one of the individuals that the mortgage is on. I think it'll be a real eye-opener for people listening. And then I know the CBC did a marketplace thing like this 15 years ago.
They did two that I know of. There was a more recent one within the last few years.
Yeah, so the one that I know of was done 15 years ago. Obviously, a lot has not changed, and a lot of people are still continuing to buy this product without being fully informed by the person that is just trying to meet a quota that they need to make, unfortunately. And we want to inform people. So hence why we've had this, and I'd say this is probably the third most asked question I get with clients. Especially when it comes to us helping them reach a goal of buying a home, is I've been offered this mortgage insurance, or sometimes they go with a different lender outside of John, but they haven't been properly informed of what the bank is offering them. So with that being said, let's kick it off.
Well, here's my first question for you, because it's a question that I'm asked. do you have to have mortgage insurance in order to qualify for your mortgage?
Uh, so there's two different types of mortgage insurance depending on what you're talking about, but I think it's mortgage life insurance is what we're talking about specifically.
Yes.
So no, and again, the impression that is often left with a lot of clients is that I need this, otherwise I can't get my mortgage, and that's often how it's being framed. And I've, again, as somebody, when I first bought my very first place, I remember the conversation that the bank had with me, and I really felt this pressure of needing to get this. But again, luckily, I had a great team with me at the time that said, "No, Ryan, you don't need this, but there's other options that you can look at to help protect your family," and that's essentially what we're going to talk about today too. So,
So
so
you
the
don't,
answer, no, you
right.
don't.
So you don't need it.
No.
Is it a good idea to have any form of coverage in the event of one of the mortgage holders passing away prematurely?
It's always a good idea to have some sort of coverage in place in case something happens to one of the people that is held on the mortgage. That way, you're protecting your family, and a lot happens, and there's a lot of situations that I know you and me, Sonia, and John have been included in, to help people make sure that everything is clear in writing as to if somebody passes, you know, that the other partner is not left with this giant debt, and that it is properly placed in the names in sequence that we want to make sure that everybody's protected. So that's another big piece that people need to be aware of. So
I feel like I'm going to be firing a bunch of questions at you now. So, what about for someone who says, I don't have a partner, I'm the only one who owns the mortgage, I don't really care if the mortgage isn't paid off if I die, so I don't really care about the life insurance. Is there something else I should consider? So, what do you think? Is there something else that someone would consider?
well, if they're the only person passing, um, it's always good to leave something for your family members to help ensure that they're taking care of your final expenses, things like that. Um, if it's a situation in which you're injured and need to make sure you keep up with your mortgage payments, if it's a situation where suddenly you have a critical illness and you're unable to work for enough time, then yes, there's two options there that we often talk to clients about, which is disability insurance and critical illness, to kind of take away the relief of that financial worry that people have, and allows them to really focus on their wellness and getting better. So we've talked about critical illness, obviously, in previous podcasts. For those just first listening, critical illness takes care of a tax-free lump sum that is paid to you, that allows you to do whatever you need to do. And for some people, it may be taking care of some of the mortgage payments so you can get well. Sometimes it's in a situation where you can pay off all of your mortgage and not have to worry about that. But people use it for getting the best treatment. People use it for often taking vacations, family vacations, because critical illnesses are often things that are survivable. And then there's the disability insurance, which is to help make up some of those things, and it's often part of the questionnaire when people are applying for disability, is what kind of expenses and what kind of income that you have that they can expect. And it's structured many different ways, so I won't dig too deeply into that. So I guess to answer your question again, yes, it's always a good thing to look at some sort of insurance. But every person is different, because you're kind of asking me generally, and I don't want to give a too general answer, but we want to make sure that the right situation for what you want specifically to happen, if you were in some sort of disability or critical illness, or if that you were to pass, even though, yes, you didn't have anybody to necessarily have to worry about your mortgage going forward. I think the bank essentially absorbs that in the passing. But yeah, there's always good place to have something small in place. That way, at least the final expenses can be taken care of for family
Right. And
members.
I
So
listen, I've had clients honestly who've said to me, Jim, I really don't care. I really legitimately don't care if I die and there's a mortgage balance. Like, it doesn't bother me. Um, but I'm more concerned about what if I do get sick and I can't make my mortgage payment? I don't want to be kicked out of my home. So yeah, critical illness for sure is a product that we talk a lot about as well. With a critical illness, you could structure it where it covers 12 months of payments, 24 months of payments, 5 years, whatever you decide, or the entire mortgage balance, right? So I think what we're trying to illustrate here right now, Ryan, with people who are listening is that why you shouldn't get mortgage insurance and should speak with a licensed insurance advisor is we can actually sit down and customize your solution based on your needs, right? Where there's very little customization available when you do get the traditional mortgage, life, critical illness, or disability insurance. I've had some clients send me their mortgage insurance policy and they will say, I have critical illness insurance. And then I read the policy, and it's not critical illness insurance, it's critical accident insurance, which is very different. And the chances of you actually claiming on that are less than 2%, right? So you need to really understand what you have. You don't want to figure that out when you're submitting a claim. You want to know before that, because if you try to find that out when you're submitting a claim and then find out, oh, I don't have the coverage that I thought I did, you're in big trouble, right? And I think what I'm going to say too, for many of you who've listened to us in the past, I'm a former banker. I used to sell this product as a banker, and when before recording this episode, and I started to kind of look back to the time when I was working at the bank, both at the branch and at the call center, and how I was trained and what was required of me. I look back now to that gym of over 30 years ago, and I just shake my head thinking, like, I cannot believe that I sold that product and how it was sold. So, for example, as an employee, and again, we're not knocking the employees of the banks. They're doing their jobs, they're doing what they're being told that they need to do from the higher ups. So please don't take this as bashing the employees of the bank. That's not what we're doing here. But I had targets as the employee of the bank. I had to sell X amount of mortgage insurance protection or creditor protection, right? So, and insurance for your line of credit or credit card, whatever else. I had a target every single week, month, and year that I had to achieve. And my compensation, or part of my compensation, was based on me meeting those targets, right? And a lot of times I was selling it not as, again, as a licensed insurance advisor, because I wasn't when I was at the bank. I was a banker, and I was providing advice on a product that I really had no true understanding of. And this is common. It's common today. You talked about the marketplace piece or pieces that they ran a couple of times. That's exactly what they uncover as well. Is that you have individuals who are selling a product who are not really licensed to understand insurance, and all they're doing is pushing that product because it's a revenue generator for the banks. And a part of one of the reasons why it's a major income generator for the banks is because many people have a difficult time claiming on those policies because of the underwriting. So, Ryan, maybe you can talk about the underwriting process or lack thereof when it comes to mortgage insurance coverage and the difference to getting your own independent policy.
yeah, so for regular insurance that uh, a licensed advisor would sell would go through a full underwritten process, which involves a questionnaire, which all and sometimes involves some sort of potential blood or urine samples, and they would actually go through and create like a risk assessment based on that. So the insurance company's taking on the risk of the individual. When it comes to banks, it's what's called post underwritten. So, which means they don't do any, often it's a questionnaire, 5 to 10 questions. And there's no actual underwritten process that the banks go through. And why do they not go through that? Because it's costly, right? It costs a lot of money to make sure that all of these things are put into place. So the underwriting costs money. So they're foregoing all those costs and making sure that, well, if we don't have to worry about them now, we'll worry about them later. So, but in the meantime, they're collecting those premiums that people are often paying. And we'll talk a lot about this too. So it's very important that people understand that what gets them is that once it comes to the time where they have to make a claim on that, they go back to the questionnaire of those simple 5 to 10 questions that you potentially asked about and signed off on. They don't include potential things that you didn't know about at the time that you were answering that questionnaire, right? So that way, that percentage, 2%, or I've seen even less than 2%, actually pay out. And it's important that we will take you down that journey of what that payout looks like. But it's a very small percentage of banks that actually pay out that money. And the question then becomes, is people think, oh, I have a life insurance policy through this institution. My family is going to be able to use that money to pay off them. So I think it's important for people to read small print. And that's the part of our job that we do is going through that small print of really informing people and making sure that they fully understand the small print. Now, I've read a lot of the banking life insurance mortgage. And if you read through the final pages of it, there's a beautiful calculation there. So I wish we had a bit of a graph too, and I'm sure this will tackle some of the other conversations that we have, which is when you start an underwriting process, the bank will set a premium, and that premium with your age will go up in time. So the premium will continue to go up, but the coverage only covers what's left on your mortgage. So you have a declining mortgage coverage. So you have less coverage coming in, and at the same time, your premiums continue to go up. Some banks have it set up so it's yearly renewal. Some will have it based on the term. Those are typically the two that I see. I don't know if you've seen any others yourself, Jim, but those are typically the two that you see, is that those premiums will continue to go up while the coverage continues to go down. At the back of many of these, we'll have a special calculation. That calculation will then tell you what percentage of the leftover mortgage will actually be covered. Often people think when you buy a life insurance policy, what I signed up for is what I'm going to get at the very end, which is not true in this case. And where I've seen anywhere between 50% and as high as 90% of the coverage is not being covered. And the important thing is that the insurance that you're buying from the mortgage is to cover the lender. Very important for people to understand this. It's to cover the lender, the bank. It is not to cover you and your family that is in need of this money, but it is to help protect the lender. So that's why we always have conversations with people to make sure that they understand the difference between having your own individual insurance versus a product like this, the mortgage insurance. I'd say 9 times out of 10, clients are often misinformed or that they don't read through the fine print, as we have, to really make sure that we're clear about what it is this coverage is, and that it's only covering the mortgage and it's only going to the lender and not your family like you probably thought. And when you first took out that $300,000 or $500,000 mortgage, you're thinking you're getting $300,000 or $500,000 back, but instead you're getting what's the balance of what's left of the mortgage. And there's only a certain percentage of that that's actually being paid out to you. So again, read the fine print. Otherwise, have a conversation with Jim or myself, or even John, to help figure out what it is that potentially they're being offered. So
Well, the problem with the fine print part, Ryan, is asking people to read the fine print. You need to be a lawyer to understand a lot of those policies. So even leaving that's part of the challenge too, is leaving it to the mortgage holder to read that policy to fully understand it. They're not going to understand because it's written in a language that is just you need to be a licensed individual. I know even with John, like he has to offer it, um, so he does, but he does say to them, "You should probably speak with an independent insurance advisor. We have one that I can refer you to because there might be a better solution for you. Chances are there is a better solution for you." So that is a conversation that he's having, but he does have to, unfortunately, offer the product right at signing. But here's the thing that he can't do, and a banker can't deny. I couldn't when I was a banker either. You're just focusing on that debt, right? So it's a $300,000 mortgage. As you should probably get this coverage to cover that mortgage. There is no other assessment done beyond that. That individual might actually require a lot more coverage than just the $300,000 mortgage. But that conversation is not happening. It can't happen because, again, they're not registered as insurance advisors. So when you are speaking with someone who's licensed, like Ryan and myself, and even Denis as part of the team, we are looking at a full assessment. So we are looking at your mortgage balance, but we also want to see, is there any other shortfalls, any other gaps in your planning, insurance planning, that we need to address. In many cases, there's a significant shortfall, and yet we can cover that total shortfall, roll the mortgage insurance into the equation as well, and whatever we quote is actually cheaper than what you're paying at the bank for the mortgage insurance alone, right? And part of that is because, from a pricing point of view, is first of all, with the mortgage life insurance, there is no male female, I think, pricing, although that might have changed with some providers. But there's also no smoker non smoker rate. Everyone qualifies as standard. So if you're someone who doesn't smoke any cigarettes, you can actually get a reduction on your life insurance coverage if you apply for an independent policy through Ryan and myself and Denis as well. You don't get that. So a lot of times we're quoting non-smoker, and people are like, "Wow, I'm paying so much more over here at the bank. Why that difference?" And a big part of it is, well, because you're a non-smoker, you get discount for that. Then there's also preferred underwriting, which we never quote preferred underwriting. I never do. Ryan, I believe you don't either. However, when you go through the medical underwriting process, depending on your health situation, you could actually qualify for a further 5 to 10% discount on your insurance coverage. You won't know that until you complete underwriting, but it is something that you could qualify for, which, again, it's not something that's offered through your traditional mortgage life insurance. Here's another thing, Ryan, that people don't really think about is a lot of people don't actually stick with the same financial institution with their mortgage throughout the life cycle of the mortgage. Many people, I forgot the number, and John could have provided that in terms of how many people actually refinance 3 years out. But usually, when they're refinancing with a new mortgage lender. It means you're losing your coverage with the mortgage lender that you had, and now you have to try to get new coverage with the new lender. You're now 3 years older, 5 years older. It's going to cost more. And also, depending on your health situation, yes, they do have 5 to 10 questions. One little change. So here's another thing from an underwriting point of view. It's an approval, non-approval. It's approval decline with the mortgage life insurance. With an independent policy, when we go through underwriting, there is a potential option for a rating. So if you were, for example, diagnosed with diabetes or high cholesterol, blood pressure, whatever else, it doesn't mean you no longer qualify for life insurance coverage, which in many cases with mortgage insurance, you would be a decline. We would potentially have a rating, which means that you would be charged a little bit more, but you'd still have life insurance coverage, right? So there's a lot more flexibility with having your own individual plan. And I think the big one, Ryan, you pointed this out. When you have the mortgage life insurance, it literally goes from the insurance company to the bank. And again, you think most of the balance is covered, but as you were mentioning, what you've read in the fine print is it could be anywhere from 6 to 90% or close to 100%, depending on the policy and the provider and whatever else. Where with us, you name a beneficiary, and then they can decide if they want to actually pay off the mortgage. Maybe they don't. So if you started off with a $300,000 insurance policy, your mortgage balance is 200. To your point, Ryan, the mortgage life insurance will cover off, some or all of that 200, and that's it. Where if you have your own individual policy and you start off at 3 and the balance is 2, you could decide, well, I'm receiving that 3 tax free. I may pay off the mortgage. I may want to wait till it renews, 2 or 3 years out, so I don't have to worry about prepayment penalties, right? And pocket the difference, which will help you deal with some short-term debt and financial situations, right? So definitely a lot more flexibility, but the underwriting one is the key one. And I know in the original piece from CBC Marketplace, one of the examples I'm trying to go from my recollection was the lady's husband passed away from a heart attack. He had mortgage life insurance.
Yep.
One of the 5 questions, I believe it was 5 questions, was, do you suffer from a heart condition? He said no. As far as he was concerned, he didn't have a heart condition. But then they uncovered he actually had high cholesterol and he was taking cholesterol medication. In the eyes of the mortgage life insurance company, that was a heart condition. Now, we could sit here and argue that all day, but I know that if I'd asked 100 people who had cholesterol, and I'm one of those people, right? Do you have a heart condition? If the person with the high cholesterol never had a heart attack or a stroke or a pacemaker or whatever else, their automatic response would be, no, I don't have a heart condition. But the technicality of how that question was written, right, in the eyes of the insurance company, well, no, you had high cholesterol, you were taking medication for it. To us, that means you had a heart condition. You had answered no. The answer should have been yes. You wouldn't have had coverage, and the balance wasn't paid. And there was too many examples like that, right? So, as we keep saying, we want to save you money, but we also want to save you from a major grief and financial issue that you could potentially face if you don't have the right type of coverage. So, I think we kind of handled the underwriting process. We talked about the coverage flexibility. Well, there's another flexibility as well with individual coverage compared to mortgage life insurance, right? Another one would be conversion privileges or switch options. So, do you want to maybe speak on that a little bit?
Yeah. So when it comes to converting a policy, so if somebody gets a 20-year, so to add to the other piece that you just kind of said is that coverage that you initially signed up with your own personal, that 300,000 coverage, you know what you're going to get at the end, and you know what your premiums are going to be for that 20-year stint. There's no increasing, there's no decreasing of the death benefit, and that your family is being able to take care of it. So, but at the end of the term, for some people, or close to the end of the term for that matter, there's a process in which you can convert. So move term insurance into more of a whole life product based on somebody's strategy of what they're looking for to get out of. And what that allows them is that flexibility to really make a better decision when it comes to their full financial plan. And some people use term insurance to tackle certain parts of their full financial plan. And then there's other people that use life insurance as life insurance was kind of intended to use during your lifetime, to use it as potentially usage of, taking out a loan on yourself, maybe using that money for the down payment, or I know lots of people use it for education or even for their own retirement plans. So there's different strategies that people can use when it comes to turning that term insurance to something that has cash value and allowing them it to work for them versus something that is used for a bulk play. The secondary piece, which my brain just immediately thought of the snow melting, and I forgot it melted away. But you mentioned
It's
something
a
else.
switch option, right? So once upon a time, if you bought, for example, 10-year term, which means that your premiums are locked in for 10 years, and then there's an increase every 10 years. If you changed your mind 3 or 4 years into the term, your only option was to apply for new coverage for whatever term you wanted, right, to change into. And then if you were approved, then you would put that policy in place, cancel the old 10-year term, and you're good to go. Unfortunately, the problem with that was sometimes in between, someone, develops again high blood pressure, cyst that's developed that could be cancerous, and all these other things. So now all of a sudden they can't get new coverage and they're stuck in that 10-year term cycle, which becomes very expensive. Even if we look at 10-year term, I believe the statistics are that only 2% of policyholders ever claim on 10-year term insurance because either you're going to outlive it because many of them expire at age 80 to 85 if you decide to pay all the way through, but most people won't because it becomes so costly that you'll just cancel the policy. So now, many insurance companies are offering what's called a switch option. So if you were back into that 10-year term policy, some companies offer you 5 years to change your mind. Some now are starting to offer 7 years to change your mind. So let's say you're 5 years in and you decide, you know what? I think really I didn't want 10. I think I do need something longer. Now you can't switch it to another 10-year, right? As long as it's a longer term than the original policy. But if you decided, I think I want to keep this for another 15 years or 20 years, you can switch it. And again, you have, depending on the company, between 5 or 7 years to go back. You don't have to qualify medically. You just go back and say, hey, I changed my mind. I thought I wanted 10. I think I want 15 or 20 years. And you can go ahead and process that switch. You don't have that flexibility again with mortgage life insurance. You're stuck in their cycle. And again, if you cancel and you move to another lender, you're now in their product. You may or may not qualify. You're going to be at a higher rate. So there's a lot of restrictions, and you're paying a lot of money for that type of coverage. I think we kind of covered everything, Ryan. Let's just see here. We talked about cost efficiency, right? So it's definitely a lot more or a lot less costly, typically, for your own individual policy over or mortgage life insurance. We talked about the flexibility, right? So again, we do have rating options, smoker, non-smoker options, female, male options, um, the switch option, conversion
Version.
option, and
Mhm.
there's a whole bunch of other ones as well that we won't get into. But if you want to find those out, reach out to us. We'd be more than happy to share what those options are with you. And it also is based on company to company. That's the other thing too is if you get your mortgage life insurance with XYZ Bank, it's not like they're shopping around the coverage. It's whoever their provider is, that's who you're getting, right? You come to us, it's I need this coverage. We're shopping that around. So that's another thing that I should point out. And I think the other thing I should also point out too, Ryan, is very important. It's portable if you get your own individual policy, right? So if you move from one lender to another, you increase your mortgage. You don't have to notify the life insurance company with any policies that we issue, right? It's portable. It's yours. It's permanent. And if you pay off your mortgage and you decide that you still want life insurance coverage, you can still maintain your coverage. That's totally up to you, right? Where that's not an option with the mortgage life insurance coverage. So we talked about cost efficiency, coverage flexibility, the underwriting process, beneficiary control, which is an important one, and comprehensive coverage. Is there anything else that I'm missing? Or I think we touched on all the points.
Pretty sure we touched upon everything when it comes to mortgage insurance and really informing people of the decision that they're making when making such a big purchase, and that often the banker, and as you said, John, it's something that they're required to do. But thankfully, we have John that is able to tell people, hey, you should really talk to a financial advisor or planner, insurance broker to really talk through whether that fits their need versus is it just covering a mortgage? Is it going to you or is it going to the lender itself? And anything else that may be important for you, the individual, whether it's child's education, covering off other debts, um, replacing income that's lost, things like that. All things to consider when it comes to making a big choice like life insurance. So
For sure. So if they want to find out more, they can find us, tvhgroup.ca, tvhfinancial.ca. You can email us financial@tvhgroup.ca or call us 647-727-4668. And Ryan, we also have some social media accounts that they can reach us at. Maybe you can share some of those with people.
Yeah, of course, with Instagram, Facebook. We're on LinkedIn also, and still on TikTok, capturing the younger audiences that I know are seeing some of this information for the first time and hearing it, especially as they're making big decisions of buying their first home, condo, things like that. So
Awesome. Well, listen, I'd like to thank everyone for watching and listening. We encourage you to subscribe, like, share, do all those wonderful things. And next week we'll have another episode. Ryan, looks like we have another one in the books. So thanks everyone for watching and listening. We appreciate your time. Take care.
Why is it me? Why am I a guy? I still buy low, still sell.